Okay, good morning. I'm doing a spontaneous video instead of one of the scripted ones, and then spending a lot of time doing the editing and everything like this. So this is just a single take, and here we go. So what I want to talk about today is the Kevin Warsh's first FOMC meeting or statement or press conference, whatever you want to call it. And his decision to hold rates steady, and I want to talk about that. But the main issue is the real interest rates. They're negative. The real interest rate is the current Fed rate, which is 3.75%, minus the current rate of inflation, which is 4.2%. So we're running at a negative 0.45 to negative 0.7%. And so what are the implications of negative real rates? And if you look at charts of real rates over time, they don't stay negative for very long. Either there's a rate hike or they have to pull the inflation down. But the implication is this, that if a foreign government or wealthy person or something buys a treasury bill, they have the expectation that the interest rates paid on that treasury bill is going to outpace inflation. And inflation is, what is inflation, right? It's the measure of the change in price of a basket of goods, like your rent, your car, dog food, electronics, whatever, just things you use in your everyday life. And that's defined by the banks or the Bureau of Statistics. Somebody defines this basket, and this is like a measuring stick to see the purchasing power of your currency. And that's something we'll get to as well, because there's a lot of assumptions and arbitrary numbers and things like this. So, and I'm saying that the Fed is boxed in. I've been saying that in previous videos. So you would think he would raise rates, to counteract the inflation. But they have a dual mandate, and he was hinting that he's more now after the inflation number. But the Fed has to do two things. They have to keep inflation at 2% while keeping unemployment under 5%. And these two things contradict each other, because let's say you lower rates and get the job market really hot, right? Then everyone starts buying stuff, everyone borrows money to buy stuff. That jacks up prices. If your demand exceeds your supply, then you get a lot of prices going up. But in the case we have now, that's not what's causing the inflation. The inflation is caused by the war in Iran and rising oil prices, which makes everything more expensive. Producing food, tractors need diesel, trucks need gas to transport items. People are buying more, spending more on gasoline for their cars. And so, they choked off 20% of the world's supply, but the demand for the fuels to power everything in the economy is the same. And now we're coming into summer, so it might even be more because people are doing road trips and things like this. So, yeah, that's the dilemma. And arguably, unemployment is low. It's well below 5%. We're at like 4.2, 4.3%, but our inflation is high. So Kevin Warsh said that, he sounded what's called hawkish. He wants to get the rates down or get the inflation down, and that would require rate hikes. But that's what should happen. We should get rate hikes, slow the economy down. But then the issue is the quality of jobs, right? Do we really have this low unemployment? That's why I say he's boxed in. Otherwise, he could easily add 50 or 100 basis points or half or full percent and easily crush the, I wouldn't say crush the inflation, but at least get the real rates positive so that our treasuries become attractive and we can keep financing the debt. But another things that box them in is the money supply keeps rising in the US, which is actually the inflation, is the rise of money supply, and the prices are just an after effect of that. But also the U.S. federal deficit keeps rising. It just keeps rising. Then we have to pay interest on that debt paid through our taxes. So I think a big chunk of our tax receipts are already paying interest on the debt. So if they raise that, then the government has to borrow more to cover its shortfall. So that's also why it's difficult to raise rates. So if he cuts rates like what everyone wanted, that would just make more inflation and discredit the U.S., discredit our treasuries. And so this is what's really going to happen. In his speech, he talked a lot about having task forces, examining the data, getting new data, and everything. I think they're going to change the definition of inflation. I saw some articles somewhere. It was like just scrolling through that they're exploring price behavior or price trends in used clothing. So maybe they will substitute new clothing for secondhand clothing. That was the word I was looking for, secondhand clothing trends. They would substitute that. Maybe they will change ground beef into bug protein. They can always do substitution in the inflation basket. So for example, back in the day, middle class housing for a typical family, starter family, husband, wife, and a kid like what I have, would be a 2-bedroom, 1-bathroom apartment. Maybe now they're going to change that, substitute a tent and 2 sleeping bags in the park. So a tent is like $150 versus $1,500 rent for the apartment, and the 2 sleeping bags are $100 a piece, and they'll track on that. And then we will have inflation actually probably even pretty low. Those items don't cost so much. And then they can start even cutting rates, and at least in paper, we'll look like everything is sound. So the way the market responded, the market first, while he was talking, started dumping. And then suddenly, it looks like, on Friday we had a risk on all your tech stocks and everything went up. And it looked like even the 10-year went down. And that's actually the market rate, right? The 10-year treasury is what the market thinks interest rates should be. And that's like 4.5%, which is just over the rate of inflation, 4.2%. Now, it can be argued that this inflation we have is because of the war, right? So this is a one-off. So as soon as the war is over, the oil prices would fall. And then the inflation number would come down in the next readout. I think every month they read this out. And then the Fed would, if they were responding in real time to inflation, they could pull rates back. So he's probably holding steady, thinking that this is going to come crashing down. Because if oil comes crashing down, then this inflation rate would come crashing down. But it was always around 3%. He said for the past 5 years we've been well over 2%. And he wanted to get that down. But he really can't. It's not 1978. We didn't have much deficits back then. Wages were, and jobs were relatively paid well compared to what housing costs. So, and the job market numbers, let's talk about that. I mean, they're counting discouraged job seekers, people who are no longer looking for work. They're not being counted, in the unemployment statistics. People working gig jobs without health insurance, without pensions and everything, they're being counted as employed. So those numbers are suspect, and he's talking about having all these task forces. These task forces are probably going to change the underlying assumptions and change the underlying numbers, so that's probably going to happen in the background. And in the meanwhile, he's going to do what Powell has been doing, and probably just talk tough, but actually not do anything. Always have some reason for not raising or wait and see, because they really can't do anything. The economy is going to be running hot, in my view. And remember, this is not financial advice. This is just my opinion, my readout, based on history, based on, if you look at all your charts, you look at your money supply charts And the money supply went down a little bit after the COVID and then started coming back up. They had tried to raise rates and then they hold them steady, rein in all the printed money. But once it's out there, you can't do anything. It'll send the economy crashing. So it looks like they resumed that. And then you can see the federal deficit keeps rising. So again, that's it's just a big mess. And so I think he's going to keep talking. He was supposed to be this dovish guy who's going to just do rate cuts, but I think what happened with Kevin Warsh is he looked under the hood. He looked under the hood of the Fed, and he was like, holy cow, this is a big mess. He can't make Trump happy, juicing the economy with rate cuts. It's just I think, to me, when he was speaking, he looked like, he was a little bit disoriented when he actually looked under the hood and looked what was inside, that this is a big mess. I mean, we can all see this a mile away. I don't know why those guys don't see what we see. I guess they don't live at street level or beach level, as one would say. Yeah, it's 5:30, 6 o'clock in the morning here in Virginia Beach. So I think it's just going to be a lot of talking, open mouth operations, they call it. Hold rates steady. If they do raise rates, it's never going to be enough to compensate inflation. So, if inflation is, if we have negative real rates of like 0.5% to 0.75% negative, they might raise it like 0.25%, but it's always going to be behind. Because if you really raise them to crush the inflation, you could break the economy like in 2008. I believe that's what happened in 2008. They raised too aggressively. They crashed a bunch of banks, and we were on the verge of a financial crisis. And then they ended up just having to cut rates anyway and, run a whole bunch of stimulus, whole bunch of quantitative easing, where basically they're selling bonds and then printing money to buy it back from themselves. Real financial engineering here. So I give Kevin Warsh, actually, I don't think he's going to serve a full term. I think he's in over his head. I think he sees the reality. He doesn't want his name on a crisis, on a big mess. Maybe he'll stay that whole term because everybody is in this situation who takes that job. But I don't see him being that different than Jerome Powell, other than maybe changing the numbers. So they will attack the inflation by changing the numbers. Like I said, substitute steak for bug protein, a 2-bedroom, 1-bathroom apartment for a starter family for a tent and 2 sleeping bags, in the park, rent-free. Transportation will be a e-scooter instead of a car, or maybe a bus pass instead of a car or something like that. I don't know. So I guess they will do that, used clothing versus new clothing, which is fine. We need to recycle more and use what's already been taken from nature versus always buying new stuff and consuming. We should maybe make use of what we have. But yeah, and how would you play this? Like right now, everything is hinging on this Iran war. Apparently they had a deal, then they didn't have a deal. Now they have a deal again. Israel and Lebanon stopped fighting. So everything hinges on that. Me personally, and this is not financial advice, I'm just in a wait and see mode. I have a past video of how I allocated, having a substantial cash position and some defensive plays like Berkshire Hathaway, S&P, and a natural gas play. Because we don't know. Iran is not Venezuela. They are ideologically driven, and Venezuela they are more financially driven. So I'm just kind of holding steady, waiting and seeing what's going to happen. I want a sure vector. I don't want to take any gambles, because if this war erupts again and then our oil reserves run out, then the inflation is going to really shoot up, and then we're really going to have a problem, right? Then the Fed has to make a decision. Do we run the economy hot and tolerate the inflation, Or does he aggressively raise rates, create unemployment, and we're back to 1978? You know, or does this war stop and the oil prices come crashing down, and at the very least he can just hold the rates steady where they're at and then slowly bring them down if inflation is dipping below 2%. But I don't see that happening, because even before the war, inflation was running hot. So yeah, I'm just waiting and seeing right now how this Iran war thing plays out, at least for the next month. If they, right now, it just had a deal to talk about making a deal, a framework agreement. They haven't really actually agreed, but at least the oil is flowing. And that's what we have to see, that the oil flows, you know, without too much disruption. And that should give the market the perception that prices will come down. But anyway, that's all I got. Have a nice day. See you. Bye-bye.